P&L had CM1, CM2, CM3 and lots of CMs, and why we need, there were logically maybe it makes sense, made sense at time to why we needed to look at all those CMs. But one call we said that okay, even if it makes us look ugly today, it's fine. But we need to simplify our articulation of our P&L, and there should be only 4 lines there: revenue, contribution, gross profit, and PBT. I mean, no community adjustment and all that.
But I think principally as you prepare for an IPO, and probably applicable to a lot of, I would say, companies, or most of the, I would say, new age companies, would be today everyone is talking about profitability. So that becomes the key, right? And to a large extent, it's now profitability in the past. If you're planning to go IPO 2 years from now, or 18 months from now, or 3 years from now, maybe start behaving like an already a listed company. I think that's the core.
Accepting, especially in my scenario, being a single founder, that you're not the superstar. You have to have superstars to drive the right processes within the company, which means an analyst can ask me, galle mein kitna coins hai? I should be prepared. If somebody asks me, aapka Kolkata mein kitna retailers plan bechte hai ya on your platform, I should know today. I think getting all those transparency, metrics right, having the right unit economics, governance, and also having the right person to drive this.
Big thanks to Dhirendra of Turtlemint, Sri of Servify, and Abhishek Bhagat of JM Financial for doing this with us. Quite an interest, I'd say, from late-stage companies in trying to go public. And from your perspective, what are the critical milestones before you think a company, particularly in the fintech space, given the recent regulations as well, what are those milestones or metrics you think are important for a company to be IPO worthy?
Thanks, Kunal, for having me here, and great to see a lot of people around. I think we've seen a lot of, obviously, companies heading towards IPO, and I think 2 segments maybe are divided into. There is obviously a segment where winner takes it all. At least that's not being talked about in the fintech industry. So I think that's a better part, because, also the market is like that. You have scores of NBFCs, you have scores of, banks, you have scores of institutions listed. So nobody is questioning or going to question that, okay, how many IPOs can potentially come from, let's say, fintech arena. But I think principally as you prepare for an IPO, and probably applicable to a lot of, I would say, companies, or most of the, I would say, new age companies, would be today everyone is talking about profitability. So that becomes the key. Right, and to a large extent, it's now profitability in the past, right? So at least 2 quarters, 3 quarters, 4 quarters, whatever it could be, but clearly that is what something is demanded by investors. So that becomes the core. I think as you prepare, I think one of the most important things which we keep talking to companies is that if you're planning to go IPO 2 years from now, or 18 months from now, or 3 years from now, maybe start behaving like an already a listed company. I think that's the core, because what we have seen is, while we are doing private deals, obviously there is a variance between what is budgeted and what is, let's say, achieved. It could be on the positive side, it could be on the negative side. I think as you prepare for being public, that variance has to be very, very insignificant, and hopefully you should be able to surprise the market in a positive way rather than negative way. But also that surprise can't be 50%, right? So I think that's one of the core things which
50% on the upside is fine. 50% on the downside is not.
Even upside is not good, is what I'm trying to say, because that
you look at Nvidia stock, it's totally fine.
Yeah.
Anyway, sorry.
But yeah, I think those. So that brings to the point that the core processes within the company should be well oiled and well greased. I think that's the most important part. right? Because your internal process, controls, budgeting, all of those should be very, very well greased. I think that is the preparation which probably is needed before you hit for an IPO.
Thanks. Maybe I'll move to both Dhiren and Sri and talk specifically about your companies. And interestingly enough, you're obviously totally in the insurance space at Turtlemint, and in a sense, Sri, you're also in the insurance space. Now in the lending space as well.
Yes.
Well, yeah. So
we launched our
getting to be more and more full stack. I think the question on most people's minds sitting outside is, from an investor side perhaps, is what are the operating changes you've made in your respective businesses as you start to think about an IPO, whether 2 years or 3 years or 4 years from now?
So thanks Blume for inviting here, and thanks for being my seed to IPO partner. So thanks Ashish and thanks Karthik. We started the company, we formed the company, and the first question that I was asking Ashish ki company kaise banate hain? So how do you register a company and all that? And I'm very happy to now, after 8 years, do a conversation related to a potential IPO. So we have started, we've always been we wanted definitely to be a company that is able to get listed, and we have been quite capital efficient in the way we built the business. And these are early days, so I'm not fully qualified, Kunal, to be able to fully articulate, because I'm yet to go through that full journey. But couple of things that we've done. One is, so we started around 6 months back. While there is a lot of secretarial, financial, software reporting, and all of those kind of work that is needed to be done. But I think one big correction that we had to do was, what do you measure? What are the metrics that you look at? And we were maybe sometimes over analyzing. Our P&L had CM1, CM2, CM3, and lots of CMs, and why we need, they were logically, maybe it made sense at time to why we needed to look at all those CMs. But one call we said that, okay, even if it makes us look ugly today, it's fine. But we need to simplify our articulation of our P&L, and there should be only 4 lines there. Revenue, contribution, gross profit, and PBT. I mean, no community adjustment and all that. And just the articulation, just the right measurement helped us now, starting to focus on each line item in terms of our P&L. And then the big thing was about communication internally, because there is a startup DNA, so there is a little bit of chaos, there is a little bit of uncertainty. Now we need to change some of that operations, and you need to maybe align a lot of your initiatives towards your P&L. So that communication itself was, while people the team, we have 3,000 people in our company and across 800 plus locations. So while just getting that done was a mammoth task. And also bringing in that belief, because for operating metrics to improve, there were certain market-related changes that we had to do, which was not fully controlled by us. The market had to respond positively to those changes, and ensure that we are continuing to be in business. And that also happened. So now as we speak, I mean, metrics are all 40 to 50% better. But all of that is in the right direction, is what I would say. And that's the journey that we are going through right now.
Sri?
I think both of them have already probably covered a lot of it, but he's probably seen a lot of it being on the banker side, advisor side. But I think as an operator, few things, I would actually bucket it in 3-4 areas. One, obviously corporate governance, which includes internal audit, have the right auditors, right metrics like Dhiren mentioned. IND-AS, being prepared for IND-AS reporting. We've already done that from last year now, because we have plans to go public in about 2 years. So we wanted to have 3 years of numbers. And some of the hard calls we had to take, just the ESOP conversion or the CCPS conversion showed us having 2,000 crores of loss within IND-AS. But that's what I think everybody understands. But like both of them mentioned, I think having the right unit in economics, governance. Third is also accepting, especially in my scenario, being a single founder, that you're not the superstar. You have to have superstars to drive the right processes within the company, which means an analyst can ask me, "Galle mein kitna coins hai?" I should be prepared. If somebody asks me, आपका कलकत्ता में कितना retailers plan बेचते हैं या on your platform, I should know today. I think getting all those transparency metrics right, having the right unit economics, governance, and also having the right person to drive this. So we've got a CFO who's got about 18 years of running public companies. So he understands all that processes, which includes timely reporting. We want to get our financials done by the 5th so that we are already operating like a public company now. So which includes having a global ERP, getting all those numbers consolidated because we run in almost 36 countries now. So I think getting all of this is also a change. Last but not the least, also like Dhiren mentioned rightly, not just running after growth. Having sustainable growth, I think, so we are already close to 1,000 crores. So even if you have a 25-30% growth, but profitable and sustainable growth, I think that's what market will respect. So in all, what we are looking at is listing at the right valuation, having the right fundamentals and governance, and then the market will anyway take care of it. So obviously, when I say profitability is one of the targets, but having the right unit economics itself, even if you're not profitable, I think you can list. But of course, considering current macro, everybody talks about profitability. And I think we will also be profitable in another couple of months, maybe this month itself. But if you have good 3-4 quarters of profitable business growing at a reasonable pace, if you are late stage, and having the right governance is including, having the right independent directors on the board, because they come with a lot of fiduciary responsibilities who will tell me to keep quiet. Yeah. I can't take decisions like how we used to probably take decisions when we were 2 years before, right? So I think getting all of that is what we are at least preparing ourselves for. And most importantly, as a founder, keeping my ego aside. It's not me alone.
Right. So, some of this is sort of the hygiene which is required to go public, right? In terms of the actual directions to your operating teams, in terms of their mindset and how they start to think about working in a company where perhaps there's a little more bureaucracy, hate to use the word, versus a startup which is far more nimble. How have your teams adjusted to this new reality?
Yeah, so this was very well articulated by one of our guys who left us about, I think, 12 months back, and then after he tried to do a startup, 9 months he tried it out, and then he came back and he joined us. And he said, oh, it feels like a different company, And so I was asking him what are the things that he sees. So I think as a founder, bureaucracy is the word we hate, right? I mean, we want to ensure that there is speed, there is faster. We continue to keep executing at the pace we would like to. But yeah, there are processes that need to be in place, because larger, sustainable, long-term organizations can be created only by having the right processes in place. And for us, getting the SOPs, documentation, risk mitigation frameworks have become, we are a regulated entity. So in a way, we are like the plus side, what Ashok mentioned, that there are positives of being a regulated entity. So we have had to do that anyway for the last so many years. But now it's even more with on our part to IPO. What we've also started doing is questioning all kinds of expenses. So, like for example, we think of ourselves as a tech company doing insurance distribution. So, but now all tech, you don't need to keep sort of creating new technology all the time and keep spending money. And sometimes the investment in the technology is more than the efficiency it can get. So, calling that out, looking at the ROI. Right. And setting the right kind of structures, and at the same time, that's a challenge I'm facing right now on speed. How do we, like earlier we were used to doing things very fast, so we are trying to orient around problems where there is a lot of collaborative kind of engagement, discussion. OKR level engagements are helping a lot, and the sort of, I hate to use that word, but we have formed committees. Those committees are cross-functional, sitting together, taking decisions on compliance, on tech, on the investment amount, and then possibly what is the business outcome. So that you allocate capital for the right initiative, because there are 110 things that you want to do, but maybe 3 or 4 make sense. So let's allocate to that, and that is a committee that is deciding.
Sri?
Yeah, almost very similar to what Dhiren mentioned. In addition, we also look at our own business models, right? Two things. One, a lot of the investors always looked at us having too concentrated businesses. Like Samsung and Apple are like 80% of our business. The reality is they are the one who are generating value, 80% of the value in the market. So obviously our business will be aligned, but if it's not Apple today, tomorrow it could be somebody else, like Nokia in the past or Blackberries in the past. But that's a reality. So we are trying to, kind of work towards that by having 4, 5, 6 customers, because that's how our business is going to be ever. So in each category, can we have somebody who's kind of taking large revenue share rather than just 2 of them? So one is concentration risk we work on, and I think we've been successful in changing that. Second is, of course, our margin portfolio. I think we are getting way better than what we planned also. So a lot of work around that, like Dhiren mentioned, every question on every expense, question on every investment, of course, rightfully. But yes, sometimes, we are a company who always had the practice of building AOP before every year, having our own strategic objectives, maybe 6 or 7, then having those 50 initiatives to achieve those objectives. Some are long-term, some are short-term. So, but to an extent, we were used to working like a large company, though internally we keep saying that we should be like a family-run organization, so decisions are taken quick. There is no bureaucracy, but when it comes to process, you should work like a large Infosys or a HDFC Bank, and especially since we are also a regulated business, any new ideas, new initiatives, we also not just think of the current legal or a regulatory framework, but how can it probably impact negatively in the future, right? A lot of businesses you've seen with regulatory frameworks changing can just impact your business and you don't know what to do. So a lot of the things that we work on, what could be the potential changes that may impact us, and should we therefore get into even such a model or not? For example, our entire lending aggregation now that we are doing, I think we spent 6 months, we hired the right consultants to advise us and talked to a lot of people who have been in the business before even thinking what should be our way of doing that business. So I think a lot of this wouldn't have happened if we had not thought of going public or becoming a publicly run company. So I think that's a change in a DNA. Obviously, culture-wise, we don't want to change and bring bureaucracies, but unfortunately at times you have to go through those processes to, maybe it will slow down, but for a sustainable business, right?
It's part of growing up.
Yeah, it's part of growing up, I think. So obviously the mindset is now changed completely from growth at any cost to sustainable growth. That I can tell you for sure.
Yeah, one of my favorite frameworks is actually that startups get growth before they get systems, and as you get larger and larger and more mature, systems come before growth, and so there's a natural evolution along that curve from one end to the other. Abhishek, maybe just a thought for you on the markets more than anything else. So about 2 years ago, we saw fintech was one of the hottest sectors of the market. We had the Affirm IPO, a whole bunch of others in fintech, and in a sense, the market has fallen a little out of love with the sector, with valuations coming down. Where do you see this headed into the future, particularly for India?
Interesting point, because we've been working on something around this. If you see, I think globally all the payments companies, since you mentioned some of them, have, I think, appreciated over the last 10 days, roughly 15 to 25%, some of the names. What we are also seeing largely in fintech ecosystem, there are only a couple of companies today, Paytm and PB Fintech. Both are at an inflection point where they're turning profitable this financial year, maybe the last quarter, and principally projecting full year profitability in FY25. So if I see what's happening, I think it's all positive from what we look at, and its models have played out. I think people have figured out where they can make money. So that's a good part, because 2 years back, I think everyone was at a proof of concept kind of stage, right? So I'm saying, obviously Paytm is making money mostly on the lending side. So they know that, market understands that to some extent, and they're valuing that. So I think we are seeing a lot of these coming back, and over the last, I think even in Indian markets, you have seen Zomato all-time low being 45, today trading at 100. A similar story for every single stock. So I think principally one of the drivers have been that they have been able to reach out to the analysts and educate them of their unique business models. Because, every single company or you have a very different model, right? So I'm saying you have yet another different model. So I think it becomes very imperative to engage with a lot of these investor and sell side analysts, right? Because it will take time for them to understand the various business model and nuances. But I think once they are able to understand, they'll be able to value you. I think that's where it all starts. Because a lot of segments which we see in India may not be easily referenceable globally, right? And that is something which is a India unique story or whatever you call it, right? So I'm saying it's important that we do that bit. But principally, we are hopefully seeing some of those things coming back.
Last question for all three of you. I'm not going to use the F word for fintech, but I'm going to use the dreaded R word. What is your view on regulations and how does it affect your respective businesses?
So we've built our business in conjunction with changing regulations, and I think we've benefited significantly from a regulations point of view, because we in a way are in business because some regulation changed in 2015, and that's what triggered our starting up. So in a way, it has worked out well for us, and each small step in the change of regulation allowed us to scale faster. And there are, at least I can think of, 5 big changes that has happened in the last 8 years of our history that has allowed us to create a model, scale up, get better margins, do consolidate revenue bookings and all of that. So so I'm quite sort of blessed in that sense, being at the right place at the right time because of the changing regulations.
For us, because we have a global business, so it's not just an India challenge, right? But in most markets, especially US and Europe, it's fairly predictable. And I think there are enough advisors to also help you get the right advice and ensure that you're compliant. But I think as a company, we have to understand that compliance, many times internally we ask, 8 घंटे का काम सबके पास है कि नहीं, right? That's how we also look at productivity. Compliance guy may not have 8 hours, but when it is required, he may have 24 hours of work. So we are saying that's something that's cost of business, that's absolutely necessary. So compliance is something that we have really taken as kind of a base with which we operate. But like in India, we've also been lucky. I think we are in an era where a lot of the regulatory frameworks and the government infrastructure is actually helping companies like us. If we do it the right way, it's only going to help. For example, the AA framework, when we are now getting into the lending aggregation side, because we are new, obviously we are able to think differently, but because we understand and want to be compliant, we will always think of compliance also as a mandatory step in the process. So with the right combination and with innovation, I think you can really bring a lot of efficiency. So I think we as a company, obviously because we want to also go public, we want to make sure that compliance is something that's non-compromised. And I think we have the right teams, right people, and that's an investment that we don't ever question.
Sure. Abhishek, in terms of the listing regulations?
No, I'll just step into their zone, but I think most of the global investors look at being compliant as a good positive note, right? So because most of the fintech segments are either RBI, AMFI, IRDA, right? So I'm saying, and these institutions have built a lot of good trust with investors globally. So I think it's a good thing that it's happening. Maybe it is sometimes inefficient or maybe sometimes it's slow, but I guess it does provide a very strong level of comfort to the investors. See, SEBI everyone has to deal with, so there's no difference between them or any other sector. I think the added comfort of RBI or institutions like that for sure creates much more, because the regulation has become a key challenge, right? So any unregulated entity or regulatory entities in the gray area will obviously find much more tougher questions to deal with. So to that extent, we see this as a positive.
There's a cleaner listing.
Yeah. Positive.
To this. So in fact, while we were working on building our lending aggregation platform, we were trying with every single digital lender what's their process, what's the plus, what's the negative. And of course, I'm not going to name it's a unicorn. We were just doing peer-to-peer lending experiment, and obviously somebody had a 860 credit score and obviously got a pre-approved limit, but he didn't take it. But unfortunately, there was a mark on his credit report as a loan already issued. And obviously it was not something, and the person is here actually, Keyur, who does all that experiment in our company. And he, because he is savvy, he also wanted to see if there is a mark that happens. So the IDFC, which is the lending institution behind, actually had created a loan. And he said, I didn't ever take it. Why are you showing this? And on, of course...
Nothing was drawn.
Nothing was drawn. He was just checking eligibility, right? But so there are small little things like a soft pull to a hard pull.
Yes.
And when you do a hard pull of your credit data, you need to also provide a reason if you're not lending, right? Here they assume the person will take, so they didn't report. Instead, they created an pre-approved customer, right? Yeah. But that's unfortunately impacting his credit history, because if he doesn't take that in the long run, it'll show as somebody who's not taken an approved loan, right? So I think a lot of these practices have to start from top leadership. Yeah. That boss, what do you want to show? Because as this company, whichever did this, showed the loan book. There are probably 30% customers who are not really taking loan, but just checking their eligibility. Sure. And that's like the loan book they have created already, right? The person is even trying to convince him, saying, "Sir, आप 2 साल रखो, कोई problem नहीं है, आपका loan already 8 लाख का loan limit create हुआ है." He's saying, "But मुझे नहीं चाहिए, आप निकाल दो." नहीं नहीं रखो sir, आपको कोई तकलीफ नहीं है. I mean, these are practices, right? And that's where I think companies have to set the right fundamentals. I think this is where governance, compliance, all of these matter. And obviously, this is only a short-term thinking. If you try these stunts, that's where the metrics, having the right metrics again. I think a lot of these things matter, and that's certainly the way we look at business.
Well, thank you. This was a lot of fun, and I hope the audience enjoyed this as well.